markets have struggled to price the risk of a disputed, contested election the way we are used to in an emerging market. How do you price that in the United States? And the market has struggled to get a grips, and for good reasons. If you look at the polling, if you look at the betting markets, it is very hard to actually get a handle on it, because there's a weird quirk in the Electoral College this year where you basically, once Biden pulls ahead at roughly 8% of the national vote, he's in for a landslide in the Electoral College. If he's ahead by 5% or 6%, it's down to one state that will separate the two. And so the markets are struggling because the margin of error is really, really tight. But the other thing is, it's one of those tail risks, which is hard to price because the downside risk is so massive. The likelihood may still seem remote, but the downside risk is asymmetric. So it's a very difficult thing to price. But one thing we do know from previous elections is that once the markets get comfortable around predicting the outcome, the pricing is reflected virtually instantly. You get that either that relief rally, or you get basically the policy premium or policy penalty of whatever future election outcome the market is seeing.
What about the corporate tax rates? Because that's something that's been under a great deal of discussion, and we heard just a slight bit ago with Rosanna's reporting there about how worrying that is for U.S. businesses. Do you think that we see that playing out in the next several days?
Yeah, I think the sequence of your questions is right. Number one is, will this be a smooth election, yes or no? Will it follow the conventional patterns of an election outcome? You then get a new policy regime. You then get markets adjusting pricing in response. And the second question, the secondary question is, okay, what does that new policy regime look like? Who are the winners? Who are the losers? And the reality is Trump was a beta president. Everything he's done has pretty much been good. It's been a tailwind for shareholders. It's been a tailwind for risk assets. A Biden regime would certainly be different. It would be much more discriminatory. It would be much more a regime that has a set of policies that's both punitive and rewarding. So there'd be a winner, create winners and losers. And so that's much more a discriminatory approach to investing, and markets would have to price that differential. But by the way, I want to point out this has been a growing trend in U.S. elections. If you look at 2016, in the 2-3 weeks after that result, you had the biggest equity sector dispersions on record. You had the top performing sector at the time, those financials, outperformed the worst performing sector by 20% within 10 days of the election, roughly. And so that tells you that's policy risk. That's political risk priced into markets.